All right, welcome to the last episode, episode 7 of the 1 Million Project, Vision 1. And here I will put everything together. I will explain to you my strategy, give you chart examples, and give you some hints and notes at the end. I want to remind you that never lose your reason why. I've talked about this in the previous videos and I want to reference it again. Never lose your reason why you're doing this. For me it's freedom, and for me it's love, and I advise you to have that reason remind you every day. And with this I want to jump into the strategy with you. So let us go and actually get into the charts, and let me explain to you how I trade and what I look for. So before we start, I want to start with something else. And I want to show you a few things just for understanding. So before we start with the strategy, there are a few things you should be aware of, and one thing is liquidity. Now, in case you don't know, there are different forms of liquidity. So for example, a range so this could be a normal range. So we have a range bound market. At some point one side gets broken, trade out traders come in, the other side gets broken, range continues. Yeah, so you can say this is a range. So this is one form of liquidity, and this especially depending on the time frame, of course, not on a seconds chart, but on a reasonable time frame. This is oftentimes, or most of the times, accumulation. So we could, for example, come from a downtrend and now we're at a critical level, price is getting here, and it's just stopping. It's accumulating all this selling pressure that's coming on to do the opposite, to break to the upside. It could then come back to this area, accumulate more, and we continue higher. And why is that? Well, as previously explained, institutions cannot just enter like we do. They must come back multiple times to a certain level. And once you understand this, you actually realize the potential, how you can trade. So this is one form of liquidity. Now another form is what I would call, so again we have accumulation here, range, but this is a channel, trend line, whatever you want to call it, doesn't matter. It's just low resistance liquidity. Why? Why that name? Why is that? Well, because once we get to that point, there is very low resistance to stop price from actually going through. So oftentimes when you see this, price is just pushing through with heavy candles because there's not enough pressure to even stop price. And now in this case, what must happen though is these price levels should all be connected, meaning mitigated. So price should not leave big or many imbalances here, and that is very objective because you can simply check if price is connected, and then there's very little reason for price to even stop here. It most of the time just goes through. And again, we're always talking in terms of probability, so there is no 100% guarantee, but this is just observation and objective data that you can accumulate. Now these are the forms of liquidity that you most likely know of. Now let us come to the most important two forms of liquidity there is. So let's say, for example, price is doing this. Now we stop at a level. Price is indeed accumulating, and now it's breaking free, and this is what happened. Okay? So let's assume this is price. So it now has created a new high in this case, and let's assume that here most of the candles are with wicks somehow connected, but we have a few areas where they are not. Okay, so let's assume it's like this. Okay, so now you have two kinds of liquidity. So first of all, you have a high and a low, and this high is an extreme point because that is an extreme high, in that example a low, inner high, and so on. So this is an extreme point. We came lower, we never came back, so this must be important. So we consider this point as external liquidity because it's external from everything that's happening here. And again, remember why this is happening, because initially price was pushed to a new level, so we came back lower again, the institutions accumulating again at an important level to then finally go higher in the desired direction and break it. So this is just an early indication. Again, we're following footsteps of the big institutions. This is just an early indication for us to follow. It's a signal, if you will. And so we are just looking for more confirmation. Now this is one confirmation, it's an early indication. So we consider this external as well as this. External liquidity, and this is also external liquidity. The high and the very low. So this is what we're looking for. We're not interested in anything between, just at the extremes. External liquidity. Now internal liquidity is when there is an imbalance. Price always needs a reason to go somewhere, and in this case price most likely will react at these internal levels too, but it will always, 99% of the time, go to the extreme internal level to then fulfill its target. And right now there are two targets. So once price broke the external liquidity level, it is most likely to go to the next most extreme internal level. Once it got here and shifted, it is most likely to go to the extreme external level. Now once it has done this and has shifted structure, it is most likely to go to the next extreme internal level again. And this is basically what's happening over and over again. So again, price with this logic can only do two things. It can go from internal to external liquidity and from external to internal liquidity. Now, what in your opinion is safer? For me, it is much safer and more likely to look for a trade from internal liquidity to external, because this is already indication that price institutions have accumulated a position, have pushed price into the desired direction, but not yet to the target. The target could be up here, but an early indication, and then we're coming to a critical level and get a shift. Like, there's not more confirmation I could get. If you trade the other way around, like here, you have to be very careful, because technically you could not know how high we would go before we reverse. There could come orders into the market, pushing it higher to then go lower. Like, there's always some more risk to this approach, which is why I would recommend half the risk if you trade external to internal. But ratios are getting pretty good, and you see it recently with many pairs. We've had huge pushes because of US election. It's now for some reversing gold, for example, and yeah, it's going external to internal. And another thing in this approach you need to note is here we have a clear target. It's the external level. That's always the target. However, in both cases you should keep something in mind. So let's assume, let me delete this. So let's assume we're coming from here. That was a bit too much, sorry. So we're coming from here, breaking higher. Now we're coming back. Okay, we're accumulating. We now have that shift of structure here. So our external target is clear, it's this. But always keep in mind, should we have a similar internal level here, price is fractal. Overall, if you got the direction right, we should get here. Like, that's for sure. But what could also happen is you don't know when. So price it could tap into an internal level. Now let's assume we've created, another one here. Don't forget, this is the external target, period. But price could now range for a long period, confuse you, and then even go lower with some news event, like very rapidly. Why? Because there might be another internal level. Again, institutions have to accumulate multiple times before they're able to go in the desired direction. This could be this. And so here you could wait for a push, but then it could not go there yet. It could again range, come back down here, confuse you, and test your patience to finally not go there again and then finally push with some news event the next week, whatever. So again, keep these levels in mind, obviously, but also keep these levels in mind, because price could do many things in between until it is good and ready. And the same thing goes for external to internal. Same thing applies here. So let's assume there are multiple internal levels, obviously, because that's most of the time the case. So when do you know when you can sell? Once recent structure is broken. So once we break here, price might come back. So where do you target? It is risky. We broke structure, and we should always get a body break, and preferably below the wicks too. A clear break. And then you should not target the external liquidity right away. You should just target the next liquidity level and then either take profit or secure the trade at break even and let it run. And then two things could happen. It could either go to this external level, or it could just do this, get here to finally move here, or it could even go higher to then shift again. And then we probably at this point have a new internal level. And then again, you don't know, it could go to this level, go higher, or it could go to this level, react, and then finally move to this and go again. So you don't know really, you just go from level to level. And that's what I wanted to explain to you. So what I'm showing you is we will mostly focus on finding trades, going from internal to external, keeping all of these things in mind. There's more that I could explain to you. I always say wicks do the damage, but they protect price. So wicks are very important because they tell a story. Like in all these cases here, wicks basically pushed above, but then showing pressure to the downside again. So depending on the time frame, wicks tell a big story. So you should always keep that in mind and keep the phases in mind. You always have these accumulation phases, channels. You then have the trend phases and so on. Okay, so let me just jump into the charts. Let's just go to GJ and I'll explain to you how I will do this. Okay, so let's start with the monthly. What's the first thing I do? First thing I do is I open a chart, I have my watch list, and I use these flags here to flag when I see a potential setup, to set my alarm and so on. So I open a chart, I have my watch list, I start from the top mostly, and I just go to the monthly and the weekly and have a look, what are we doing. Now, what I can see here, this is too much. I mean, this is over 20 years ago, long history. So that's for now irrelevant because it's just too much data. Okay, we're on a monthly, we're in a clear uptrend. That's for sure. Here's an external level from the 2007 crisis. Okay, cool. Now, we even broke here recent structure on a monthly, a few months back. Okay, crazy. Then we had some Japanese yen intervention, I think, in here. So that's fundamental data. We don't have to care about this right now. So all we do is we have a look at the trend. This is the monthly. Monthly is very bullish at this point. All right. Okay. So now we go to the weekly. Now we have a look. What have I just explained? This here is basically a accumulation. All right. We then pushed higher. So this is some sort of important area. Nevertheless, let's make it very simple. We're in an uptrend. Okay. From here, we're in an uptrend. Now, what are we looking for? I told you price is going from internal to external. Here, for example, we have an internal level, which was a huge accumulation area for price to then push higher. Now, you have smaller external levels, these ones, which all get broken, but then you have a really like this huge external level to the left, which is still relevant. Okay, so we're going there. Price is fractal. Now we've broken it. So we have broken the external level. What is price going to do now? It is going to some internal level. Now the thing is, you don't know which internal level. I mean, we have ones down here. So technically price could go for years all the way down here to then reverse. Okay, fine. But all we focus is the next logical area and the extreme internal level. Now, here we have multiple. We have one here. Here we have a small one. This already got used. So this is irrelevant for me. Once it got used, it's irrelevant because its purpose was already fulfilled. Let's put it this way. Now, as you can see, once we tap in here, we have a smaller reaction, which is a big reaction on the hourly, for example, but we did not take out the external level here. Why? Because we have an extreme internal level, which is down here. So we have all of these, but this is the extreme level down here on the weekly. Now let's go down on the daily, and here it becomes a little bit clearer. So here is the level on the daily. We can delete the other one. So this is the precise level here. And why this level? Well, obviously we had this weekly internal liquidity level. We pushed higher, we used it, important area, boom, pushed higher, we stopped here. Can we notice every time? No. In this example, it also could have gone lower to this, for example. It didn't. But this is why this is just an indication. So what is the critical thing we need to wait for? Confirmation. Once we have identified a trend, like it stopped in the middle of nowhere, that's good because it has reason to go up here again, because that is an indication we did not mitigate something to the left and reverse to go lower. We just created a new high in this case and created an indication like institutions accumulated. Now we came back for them to accumulate more. This is the logic. So trend is up, new high. We identified the internal liquidity. Now price comes into this. Our alarm, which we have set to this level, has rang. So we're alert and we go to the chart and we simply wait. Okay, price tapped into here. Now we wait for confirmation. We want to see a market structure shift. And so if we are in an uptrend, price needs to break the latest low in order for us to go lower. Okay, so that is the logic. And in this case, vice versa, the other way around. So we need to break to the upside. Now this is the daily chart. So here obviously it takes longer. So here it broke and it broke again. So here you have a clear market structure shift. Now this is now our confirmation. Now how do we enter? You have now several opportunities depending on your appetite and risk level. All of these have advantages and disadvantages. So obviously whenever you have a bigger ratio, you get into more trades, but you also get less reward. With a bigger risk to reward ratio, as the name says, reward is bigger, but risk is also higher because it could be too tight, whatever, or price could not even go there. You miss the trade and it goes without you. So I think there is a sweet spot. So you could either look, in this example, there is no internal level on the daily. you could either look for another internal level after the shift, which could be found on a lower time frame. So for example, here is one, we've already used it. Here's one, we've already used it. Now here's one, we did not use it, so price came here. But again, this is one way, and then again on a lower time frame looking for a shift, and then you can do two things. Like assume we have a shift here, you could then, let's say, or let me show it to you with a real example. So again, price came into here, okay, but we didn't get a shift here yet. So it went lower, we avoided a loss. Now it shifted with full body. So we assume that this is the lowest price can go again to fly higher, and that's actually exactly what it did, and it gives us multiple confirmations. So we have a first shift here creating new high, this one, and so on. It comes lower and it gives us another shift. So there's multiple confirmations already, and this also happens to be right here at the daily auto clock. So here it's the daily auto clock, and it just happens to be right at this auto clock. So again, to make it very simple, you wait for that shift after we have touched into internal liquidity, and you then can do the same thing scaled down to get a very precise entry, like I've shown to you right now. You wait for the touch of the auto clock, you again wait for a shift, or again you look for an internal level and you wait for the shift again. Now, where do you place your stop loss to? In this example, the price again came into this internal level. We have shifted here, so you can do two things. It's more risky, so you can again wait for the auto clock to be touched, like here, or an internal level on a lower time frame again. And now, since we have shifted already, you put the stop loss below here. So that would be reasonable, and target what? The external level. And this is a great risk to reward ratio. Now, if that is too risky for you, you can do also this, which is still a great ratio. You can include this very low, because sometimes obviously price spikes lower, there's some news, it accumulates more, and that's very heavy if you get stopped out and then price runs into your direction. So that's, you tend to get very emotional about these, and this is how you can avoid this. And with this you don't have to be so precise, you just give your trade a little bit more room to breathe. And so you just can include the low, even the very low to be precise, and target this. And then what? We've scaled it down 3 times basically. What is this? That's just the recent external. What is the real external? Yeah, obviously this. So this is a much better ratio, but you obviously need a lot more patience and time with this. So there are several ways how you can approach this. I advise you to always do the same thing and to stay objective. There's no room for subjectivity in here other than these levels, which some people may not recognize, so you have to practice. But this is basically it. Now again, let me show you what an internal level is like. Let's make it very simple. I can, like, okay, if I, let's start with this candle. If I try to connect all of the candles, okay? And they all connect, price is efficient. But if there is a gap in between, like 1, 2, 3, you obviously always need 3 candles to recognize if they connect or not. So again, let's have a look at these here. They connect in this example. And from a broader perspective, so again, let me show you. Like 1, 2, 3. And even between these, there's not a gap. So the wicks are connected, like everything's fine. There is no gap. So you always need 3 candles. Here in this example, there is a gap. And you can see how price perfectly taps into this. Because again, price tends to stay efficient. It is important. Plus, here's an auto block sitting, this one. So this is basically an internal level. Here, same thing again. 1, 2, 3 candles. There's a gap in between. Price comes into there, again taps this order block. This is external liquidity. And this is how trends are created. Now next example, 1, 2, 3. 1, 2, 3. These are all connected. Here we have a gap. So this is how you spot them. Here, 1, 2, 3, there's a small gap, price comes into there. Same thing. Here, 1, 2, 3, gap, price comes into there, makes it efficient. This is all accumulation, efficient, boom. Pushes free. Here, internal level, price comes into this and stops at the order block. Then again, same thing, internal level, boom, price comes into it, goes to external. So that's always the same thing. Now, here obviously the ratio would not be good because this would be considered the low and so on. So not every level is perfect and good, but still it works. Here, same thing. So I can do this over and over again. Here, small one taps into this. Small one taps into this. This is all efficient. Then here, imbalance, price taps into it, pushes to external. Like that's always happening. Now here, same thing. Price comes into this, has a small reaction, but pushes lower. And this is again why we can't just solely trade internal liquidity. We need that confirmation. But that is just going to show you, look at how many times it has worked going to external, and then this one time it broke lower. So, and this combined with confirmation is so powerful. Now let's have a look. Here, if you look closely, we have this small imbalance, and now look where price is going to. So it did not. This was already used, this technically too. Price decided to tap into this. Now again, we've got the tap already at the lower order block, the daily. We got the shift, that's it. You can look for more confirmation on the lower time frame, that's it. Now let's have a look at some more examples. Yeah, so the Dow, pretty crazy, US election, it's just crazy what's happening. So have a look here, same thing. If we just look recently, yeah, let me go week by week. Here we have that internal level. If we are precise, price just taps into there, goes to external. Then what happened? Again, this is the weekly, got that internal level, price taps into there. Here it's all mitigated. This is the auto plug to external. Again, here, this is all efficient. Here, internal level, price taps into it, comes down to the auto plug because it wasn't mitigated, and reverses again to external. Now again, this is a clear uptrend. Here, same thing, took external. There's the internal level, again, takes external. Now here again, there's the internal level. Price comes in here multiple times. So first time takes out external, again takes out external, runs, comes in here again, and this is election, boom, big candle, boom, pushing higher. Now let's have a look how you can actually trade this. So let's go on the 4-hour time frame. Let's just start here. So obviously you see we slightly broke the high. Now let's have a look at mitigations. Here's an internal level, it was already used. Here's another internal level, it was also used. This was not used, so this could be very relevant. So we're just refining the level right here. Now here's the auto plug. The rest looks pretty efficient and mitigated. So price comes here. All we need right now is a shift in market structure. And now there's the last thing that I want to explain to you, and that is I say there are micro shifts, and so let me explain that to you again. There's a real shift and a micro shift. So you all learned higher highs, higher lows. This is an uptrend. Now, what is the last real low? This one. So for us to change the trend, we must break with the body this low. Okay. So, but this is the real low we must break, but we always will get a micro shift before that happens, which is obviously more risky, but it's an early indication, if you will, that we get the break. And if that happens to be right at this internal level at an auto plug, that's all the confirmation you need for a good ratio. So you can do this, or simply wait until we break here, have a bigger stop loss, and trade this. This is up to you, but a micro shift would just be this. So we again create this on a smaller scale, but we break through this, and this is a micro shift because this is the real shift. Actually, yeah, we shouldn't come higher. So this is the real shift, this is the micro shift. And so you could already enter here, but price now must break below here. If we don't, we could go higher and you could lose money. So you definitely need to manage the position more strictly with that micro shift. But if we break here, you just got in early and lucky, and you've got a hell of a trade. And this is basically, yeah, what you can look for. This is what you can look for. So yeah, here we were. So again, let me show you. So this is the basically the real last high, which we must break. But this here is the micro shift. Can you see the difference? The difference would be this. If you do it strictly, this is the low that's protected, which you should target. That is not even a one-to-one. So this trade would not be worth to trade for you unless you would do this, which would be a little bit more risky than this, which would be a one-to-one. Still not a great trade. Not every trade has a good ratio. But if you would look at this, look at what ratio this would be. A 1-to-8. That's crazy. So, however, you see we did not break here right away. It came back down. So he had a little bit of trouble. Should put the trade to break even. Whatever. Right? Now, if you... Here again, you have two opportunities. It's always two. You could use the tight stop loss management, or you look at the structural levels, like what is the real low that is protected, that broke the external. It's here, it's down here. So you could include the body around the wick, and this is still a better ratio than this trade. Just because you're right at the spot, you're looking at the micro shift, and that's it. So you can decide, but you should always be strict with your placement and management. But yeah, this is basically it. So here again, we have the internal level. Price comes into this. We have a lot of low resistance liquidity here. The price is just pushing through, as you can see. And then we have the auto block down here. And now what is the the real shift? Where is it happening? Well, obviously this is the very high that broke this one, but we also have these micro levels in here, so we can just use these, and then even this micro shift. So that's up to you. In this case, I would just wait for the break here, so something like this. And then obviously you have that internal level here, which I would be mindful of. We already touched into this. So this would be very, very risky. This would be fine. And then you still have a pretty good ratio in this example. Okay. And now again, we target external, but in an uptrend, prices go higher. So yeah, sometimes slightly and then reverse again, sometimes big time. You don't know that beforehand, obviously. But yeah, this is how it works. Now, last thing, keep news in mind, because news on a smaller time frame could ruin your trade, obviously. So keep that in mind. And yes, that's it for the strategy. I will probably make more videos to explain some more details and some tips I want to give you to keep in mind. Again, always look at the wicks, look at the internal levels, look for a clear break. And the last thing I can tell you is price definitely tells a story. So if price does not break with a body, that means a different thing that when it breaks with a wick. So just keep that in mind. And yeah, that's basically it for this video, for all of these episodes. I hope that helped you if you've watched till the end. Happy to have you here, and I would love some feedback. And yeah, feel free to write me, and all the best to you. I will now continue with my project, with my vision, work on myself, and I tell you, I see you on the other side of financial freedom. Have a good one, much love, and I love what I do. See you.